afternoon, everyone, and welcome to our webinar, Top 10 Things to Look Out For on Clients' Personal Tax Returns. I'm Samantha Brennan, the Director of Business Development here at KLG, and your moderator for today. The session will run for about an hour with a presentation followed by a Q&A. So if you have any questions, you can type them in the Q&A box and we'll address them at the end. I'm excited to introduce today's speakers, David Gralnick and Lou Panariello, partners here at KLG with decades of combined experience in forensic accounting and business valuation. Before we begin, a quick disclaimer: this presentation does not provide legal, accounting, valuation, or tax advice and should not be construed as such. It's for informational purposes only, and examples are illustrative. Please do not distribute these materials without KLG's consent. And without further ado, let's get into today's topic. David and Lou, take it away.
Thanks, Sammy. Today we're going to talk about top 10 critical issues to be aware of on tax returns. So with the personal tax extension deadline only a few days away, you'll probably be receiving a number of tax returns in your cases. We thought this would be a good time for us to point out some critical areas and issues on tax returns for attorneys to be on the lookout, which will help you with your cases and to identify possible assets and other issues. If you have any questions, please type them into the Q&A section of the Zoom. So without further ado, Lou, take it away and try to stick to the presentation, not go off on too many tangents.
Come on, big win yesterday. You have to bring them up at some point. All right. Just a quick overview on what we're going to talk about today. We're going to talk about cryptocurrency and how to find them on the tax return. Filing statuses and what that means for that particular tax return, dependents and how to deal with them within your case, refunds and overpayments, things to look out for with that, deductions, itemized or standard deductions, and how those are calculated and why they're meaningful within your case. We're going to look at bank and brokerage accounts that are listed on the tax returns, foreign assets, real important topic, carry forwards. So David will get into that. The sale of assets and how to find them within a Form 1040. And we'll finish it up with business entities, real estate rentals, and how to identify those within the tax returns as well. All right. So let's get into our first topic, which is cryptocurrency, which if you watched our webinar that Dave and I gave a couple of weeks ago, a lot of this may be a little repetitive, but it's very important, and it's an ever-growing topic of discussion. So cryptocurrency and other digital assets, they were really once considered the Wild West of investing, and they're still risky and they're still volatile, but the reporting requirements have become much more sophisticated over the years. So in 2020. The IRS introduced this box that you see here over on the right. Now, this is right on the first page of the tax return. Let me zoom in there. All right, so this is right on page 1 of Form 1040, and it requires the taxpayer to disclose whether or not they received or sold digital assets. Now, the nomenclature here is very important, right? Receive as a reward, award, or payment for property, or sell. It doesn't say buy, right? So just keep in mind that just because this box is not checked off yet, it doesn't necessarily mean that, cryptocurrency wasn't purchased. But this is certainly a good area to look right on the first page to determine if this particular taxpayer and your client or the other side's client, if they are investing in any way, shape, or form in digital assets. And it's sort of a starting point for your digital discovery. The second place within the Form 1040 that you can look, just looking for where my cursor went. Here we go. All right. So this is Schedule D. Which is for reporting capital gains and losses on the sale of property on Form 1040. So we talked about what the IRS did in 2020. So let's go even further back to 2014 when Bitcoin and really it was Bitcoin at the time started to become sort of the talk of the town, and a little bit of a bigger issue for the IRS because a lot of that stuff was unregulated, and people weren't reporting these massive gains that they were earning out of Bitcoin. So in 2014, the IRS considered cryptocurrency and digital assets to be quote unquote property. And the significance of that is that if a taxpayer or a spouse, in your case, if they were to sell any cryptocurrency during the year, those sales have to be reported on Schedule D. So we pointed out here, which is Schedule D. So these are sort of the summary sections of Schedule D. So if you see numbers here, what this means is you have to look to the second page, which is Form 8949. So that is right here. So Form 8949 is going to give you the detail for the quote unquote property that was sold during the year. And why is this important? Because even though we're looking at assets that are sold and gone, we use that date of acquisition sort of as a frame of reference to find out when a specific party to a case started dealing with cryptocurrency. So even though we're looking at, a potential marital asset that's being sold and it's no longer, something that is owned by the parties, the significance here is that date of acquisition and how much was purchased at the time. So we use that, as sort of a start for a tracing, but just a quick look at this form sort of gives you a quick idea as to, again, whether or not you're dealing with a case that's going to involve cryptocurrency and digital assets. And it's great, this is great because it's the start of a paper trail. And when it comes to cryptocurrency, the start of any paper trail is going to be the bank statements. And you're going to want to look for transfers of money into like a Coinbase or a Binance or an exchange like that. So at least this statement's going to help you, like I said, get that frame of reference and a time frame to look at. All right, our next topic, we're going back to page 1 for our next topic. So this is going to be on the filing status. So filing status, again, right on page 1 of the tax return, and it's right at the top. So this may seem elementary, but this is really important because this is going to let you know exactly whose tax return you're looking at, right? Up at the top here, it may have, a couple of parties' names, but what you want to look at here is the filing status. Is this tax return for just one spouse? Is it for both spouses? Do you have to go and get the tax returns for the other spouse? When you're looking through this tax return and you're looking through the assets that are on here and you're looking at the income that's on this tax return, is it for one spouse, both spouses, the other spouse? So it may seem elementary, but it's important to know exactly whose assets and income you're looking at when you're going through Form 1040. Okay. Moving further down on page 1. Okay. So we're going to talk about dependents. So what is a dependent? A dependent is a qualifying child or a qualifying relative of the taxpayer. It's not a spouse. You can't claim your spouse as a dependent, but there's certain qualifications for children and stepchilds and brothers and sisters and parents in order to claim them as a dependent. Now, prior to 2018, you would list your dependents on this box that you're looking at, and then you would get a deduction from your taxable income of, I think it was $4,700 for each dependent that qualified. In 2018, there was the Tax Cuts and Jobs Act that we all know. So for the tax years 2018 to 2025, that dependency deduction went away. And now it's replaced with a dollar-for-dollar tax credit. Examples are the child tax credit, the child and dependent care credit. So those are now in place of that deduction. Okay, so why is this important? Who's claiming the dependents? If you're filing separate tax returns, married filing separate, or now you're now the marriage is done and the divorce is complete and each party is filing a single tax return, uh, who's taking the dependents? Both parties, both spouses cannot claim uh, the same dependent. So if there's one child, you have to negotiate who's going to claim that dependent and get that tax credit going into the future. So it's important to kind of keep that in the back of your head if you have 3 or 4 kids and you're talking about 12 or $15,000 of a tax credit going into the future. Who's going to get that tax credit and how's it going to be negotiated in a settlement? Keep in mind that the Tax Cuts and Jobs Act, the TCJA, as a lot of people know it sunsets in 2025. So keep an eye on what happens, and we'll do another one of these webinars when there's some sort of guidance from the IRS as to what's happening with the TCJA when it sunsets in 2025. But you do want to keep an eye on what happens with dependents going into the future. Is it going to be tax credits? Is it going to be a deduction from income? And you may want to include in your settlement agreement just sort of a caveat that whatever is agreed to with regard to those credits and deductions may change in 2025. So just keep that in mind. So now I'll kick it over to Dave.
And just to add something to that, Lou, the tax credits that you get are subject to income limitations. So when you're looking at these things, it may behoove, one of the spouses to get, because if they're making a significantly less and they're filing marriage separate, then they may be able to get the tax credit and the other spouse may not. So, things like that are important to look for and to try and note in what you're doing. So that's an important thing when people are like, well, can you review the return? Is it right? You may want to advise them, hey, you may be able to get the tax credits for the children because your spouse who's taking them as dependents makes too much money to get those credits. So just another thought to put in the back of your heads.
Yep, and I think that income phase out is $200,000 a year. So if you're working with one spouse that's over and above the $200,000 a year and another spouse that is below it, just keep that in mind when you're allocating those dependents.
Okay, moving on. Number 4. Tax refund overpayments. Very important. When you get the tax returns, you may want to look. Line 34, refunds. Is there an amount overpaid? If there is a refund, is it going to be sent to you? Line 35, it'll give you a checking account or a savings account with an account number where it's going to be sent. Or is it going to be something that's going to be applied to your next year's estimates? If either of those are the case, that may be an asset of the parties, especially if it's if it's applied to the 2024 estimate, then whoever's, the main taxpayer, if they're divorced in 2024, is going to get to take that tax payment. So that estimate. So you would want to account for that in the assets when you're divvying up, especially in a matrimonial, when you're divvying them up. So you need to look for to see if there's any overpayments, and if those overpayments are either going to go into a bank account or if they're going to be applied to the estimates or some combination thereof, because you can obviously do both. Not to mention, obviously, if there's an amount owed, you want to look at that as well, just to be aware of the liability that's coming your way. Moving on. Itemized deduction or standard deduction. So this is important for a couple of reasons. First of all, you want to see, if there's interest paid on a mortgage, you can look at that to make sure that, if somebody says there's interest, that there's a mortgage listed on the net worth statement or financial affidavit if you're in Connecticut, if you're joining us from Connecticut. If they're making gifts to charity, they'll give an amount we see a lot of times on a net worth statement where they say, oh, we give $1,500 a month to charity. And then on a tax return, there's, $332 of charitable donations. So you want to look to kind of make sure that what is on the either net worth statement or financial affidavit under expenses matches what's on the tax return, just for those purposes. But even more importantly, if you're filing married separate, if one of the parties is filing and itemizing their deduction, then the other party must file and itemize their deductions as well. So if one party's taking a mortgage interest and state taxes and all the charitable donations, and they're going to have a large kind of like almost a credit, but a deduction against their income, the other person may have none of that, and they may get zero deduction against it. So you need to be aware of those kind of issues when you're looking at the returns, because if someone asks you your advice, hey, should I itemize? Well, do you know what your spouse is doing? Because if they're itemizing, they must itemize as well. You're on mute, Lou.
Sorry about that. Okay. All right. Point number 6, bank and brokerage accounts. So Schedule B is utilized for a few things. We're actually going to get to all 3, but for this purpose, we're going to look at Part 1 and Part 2. So Part 1 is for interest income derived from bank and brokerage accounts, but also from pass-through business interests, which David's going to get into in a little bit. Part 2 is for reporting ordinary dividends. Again, probably not from a bank account, but from a brokerage account and the securities that are owned in that brokerage account, and also from C corporations. David's going to get into that a little bit later. But why do we use Part 1 and Part 2 of Schedule B? Simply for the fact that it helps to identify bank accounts and brokerage accounts. As David mentioned a little while ago, in New York State, the parties are required to fill out a statement of net worth. For our friends in Connecticut, it's going to be called a financial affidavit. And each of these documents they're sworn documents as to income, expenses, and assets and liabilities. And I can't tell you how often we review a statement of net worth and we're comparing it with the information that is on Schedule B here, only to find that one of the parties omitted a bank or a brokerage account from their net worth statement or their financial affidavit. It could be out of sight, out of mind. Some cases, involve dozens of bank accounts and brokerage accounts. When an accountant's doing a tax return, they're relying on the 1099s that come directly from the financial institution. So it's less likely that they're going to miss anything within the tax filing. So this is a real easy way of comparing that financial disclosure with a tax return and all of the bank information that's provided here.
Sorry, Lou, just to throw something in also, just keep in mind that these are accounts that earn interest. There are accounts that don't earn interest, number one. But number two, it's possible that an account earns interest but is closed partway through the year. And that's why it would be on a tax return and not necessarily on a net worth statement as well. Because if it was, if the date of commencement is late in the year and it was closed in March or April, there still might be some interest, but the account doesn't exist anymore.
All right. Okay, our topic number 7. So we're going to stick with Schedule B. So I mentioned that there's 3 parts. So Part 3 is going to be for foreign assets. So Part 3 is relating to Form 114. So Form 114 is used to report a financial interest, a signature authority, or any other authority over one or more financial accounts that are in foreign countries. The threshold to report a Form 114 or 114 is only $10,000, which is pretty low. So if someone has foreign assets, Form 114 is probably going to be something they'll be working with. Here's the rub. Form 114 is not an IRS form, and therefore it's not actually attached to the Form 1040. Form 114 is actually reported to another bureau within the United States Department of Treasury. That's called the Financial Crimes Enforcement Network. The acronym for that is FinCEN. So people are more familiar with FinCEN, but that's who Form 114 gets reported to. However, if the box is here, and I'll zoom in so you can see the actual wording here. So if the box is here that anytime during the tax year, Form 114 was filed with FinCEN, and they check off the box, yes, you're going to want to include that form in your discovery demands to make sure that all foreign assets are accounted for on that statement of net worth or financial affidavit. Now, the IRS does have its own form for foreign assets, and that's going to be Form 8938. The threshold for filing a Form 8938 is much higher, though. That is if you end the tax year with $100,000 of foreign assets or more, or if at any point during the tax year you owned $150,000 or more. So those are going to be the two requirements for filing Form 8938. Now, given the thresholds, it's conceivable that somebody has to file, Form 114 with FinCEN, but this schedule is completely empty. So just because this schedule is empty doesn't mean you shouldn't go and look at this Part 3 of Schedule B. Now, the second page of Form 8938 is going to actually give you some data. So Part 5 at the top here, these are where the bank accounts are reported. They call them foreign deposit accounts. So if you're working with bank accounts, you're going to want to look here. It's going to give you the financial institution, the type of account, the account number, the currency that the account is in, the country that the account is held in. So it's a lot of good information to get started on finding those foreign assets. A little further down, so this Part 6 is really for anything that's not a bank account that is a foreign asset. So think real estate, think business interests, think other investments like a hedge fund investment, some sort of an offshore account in a hedge fund, things of that nature. That is what's going to get reported on Part 6 here. And just keep in mind that if there's multiple assets, they don't really give a lot of room here to report all of the assets. So there could be a subschedule that gets attached.
Okay, moving on. Capital loss carry forwards. If you look at lines 6 and 14 of Schedule D, you will see that there could be some kind of capital loss carry forwards. So if these numbers are filled out on 6 and 14, and they add up to more than the what is essentially the income in 7 and 4, is it 14? Lou just made it. 7 and 14 and 15, okay? Then you will have a capital loss carry forward going into the next year as long as it's more than either $1,500 or $3,000. So what you want to do is the second page of the Schedule D. If you look at line 16, that'll give you the amount, okay? And then up there, you're combining the results. And if you go to line 21, I believe, okay? So this deducts the loss that you're taking, okay? So once you take that number less the loss that you're taking, either 3,000 married separate, either 3,000 or 1,500 married separate, then there will be some kind of capital loss carry forward into the future. And that could be an asset. It could be a very large number sometimes. We've seen $1 million, $2 million numbers. That basically means that someone has $1 to $2 million of capital gains that they can take into the future without paying $1 of tax. So that could be a very important asset not to be overlooked. So you want to look here to see if that is certainly one of the issues or a possibility. In addition, we have net operating loss carryforwards. So if you go to Schedule 1 of the tax return, line 8A, there's a net operating loss. That'll be from prior years, okay? And then at the end of I believe it is at the end of page 1 of the tax return, if you go back, Luke, and you go all the way back to the first page of the slides. We just want to show you where to look. So if you look at the taxable income down there and that's negative, then there's probably on line 15, there's probably a capital loss carry forward that will be going into the future. Okay, and there will be a schedule usually of it. And you want to take that into account because again, we've seen large numbers here, $100, $200, $300,000. Someone can take taxable income. They can earn $300,000 the next year and not pay $1 of tax. Now that should be a marital asset, possibly. You'll have to look at timing of things. Sometimes, data commencement, timing of the losses, timing of the gains, all that stuff. But it could be a marital asset that you want to take into account and you want to note for your clients. Moving back. Number 9. Sale of assets. So these are going to be, again, capital assets. So sale of assets would include basically your stocks and bonds, mutual funds, anything you're going to get a 1099-B for, but also your house, which would go on schedule. It wouldn't go on Schedule D, but it'll go later on. There's a second part of Schedule D. Okay, a house possibly, or any other asset or company could go on here. So you want to look to see all these things, and you want to see if somebody is saying that, hey, I sold this. You want to make sure that it appears on Schedule D because you need to check to make sure the assets are all accounted for, obviously. And if somebody's saying they sold something and you do not see it on Schedule D, well, then you know that they probably didn't sell it or they didn't report it for whatever reason. So those are things that you're going to want to look into and try and make sure that your clients are protected as well and things like that. Okay, this is page 2 of Schedule D, or sales and other dispositioning assets. Basically, this is where you're going to list all of those assets. So it's the piece of property, the date acquired, the date sold, how much you sold it for, what the cost basis is, if there's any adjustments, and then what the gain or loss is. There was a question given, can a capital loss carry forward only be used to offset capital gains? Yes, capital loss carry forwards are only taken against capital gains in the future. They cannot go against regular income. An NOL can go against regular income, but a capital loss carry forward would only go against capital gains. So thank you for that question. Moving on, number 9, we finished with sale of assets, I believe. So that'll bring us to number 10. Business entities and rental real estate. We've all seen Form Schedule E. This one is page 1. This will show any real estate that's rented or any royalties they receive. So you're going to want to look to this if somebody has properties that they say are rented. Or if you see these that they're rented and not listed on the net worth statement, you know that something is going on. And then if you could go to page 2, Lou, the one we're all a little more familiar with, this is where you're going to find your businesses, your S Corps and your partnerships, not your C Corps, only your S Corps and your partnerships. But you're going to want to look to this to see if there's income, if they're listed, because even if there's no income or loss, technically those should be listed. Sometimes we see they're not listed, but they should still be listed. Sometimes we see there's an entire subschedule to this. It'll say see schedule, like at 5 or something, and you'll go to schedule 5 and it'll list 10, 15 of these, depending on how many there are. Another place you're going to want to look to see if they have any business assets. Sometimes we see, as Lou had mentioned on Schedule B, we have, income, so like interest income or dividends that flow through to Schedule B. So you're going to want to look at Schedule B. Sometimes it'll say from K1, and it'll list the name of the K1, and then you're going to want to see it here in parts 1 or part 2. If you see that, you have another business that you've got to account for if it's not listed for some reason on Schedule E. So those are all reasons, things you need to look at. Those are all important things we think you need to understand and be on the lookout for as the personal tax deadline approaches. So if anybody has any questions they want us to kind of answer or go through, if they could fill it into the question and answer. We got one now. How many years can you carry forward a capital loss? Okay, so under the current law, a carry forward goes into perpetuity. There is no limit. It used to be there was a limit, but that limit in the Tax Cuts and Jobs Act has gone away, and it's into perpetuity. So there is actually currently no limit. Does anybody, okay, can spouses agree to divide a capital loss for when they file separate returns? So that's a good question as well. The capital loss is going to be in the name of the person who's on the account, or it's their social security number. So that's the person who's going to get the capital loss. So they can't just agree to take it because the IRS won't recognize it. They'll only recognize it from the social security number. So they can't agree to divide the capital loss when they file the returns as separate. So somebody's going to get it, which is why we say be on the lookout for it. It could be an asset of the parties.
Right. So as an illustrative example, if there's 2 spouses and spouse A has a brokerage account and sells X amount of shares of ABC stock that spurs $2 million of losses, and they carry forward those losses into the future, only spouse A's name is on that account. Only spouse A can take that carry forward into the future. Spouse B won't benefit from it. Any other questions?
There's another question. Since it's an asset, how do you equalize it so the other spouse gets the benefit? So this is something that we kind of, we talk about all the time. So this is kind of somewhat speculative because you're assuming, so if say it's $1 million capital loss, you're assuming someone is going to have $1 million in capital gains into the future. Okay. And you don't know if that's going to be in year 1, year 2, year 8, year 20. So what we usually do is we look at the history of the, and Lou, you could help me out with this. We look at the history of the capital gains we've had
yep.
Over the course of a number of years and see how many years it's going to take based on history for them to basically utilize that entire capital carry forward loss. And then we present value it using a certain risk rate. And obviously that risk rate changes. It's, based upon certain factors.
Right. So basically one person's taking the carry forward into the future, and then using that carry forward, we estimate what that tax asset is going to be. And this way you can use that sort of number in negotiating a settlement.
Right. And we're going to utilize both the federal long-term rates usually. And then because most carry forward gains are long-term. It's just how it is. Obviously, if you look though at the history and it's a lot of short-term, we'll use we'll use the regular rates, and then you'll use the regular income rates from the state as well to account for that. Anybody else have any questions? Okay, Lou, you want to talk about your Mets again?
Nope. See you in the National League Championship Series. Let's go.
Okay. All right. Thank you, everybody, for joining us. We hope that this was helpful to you guys, and have a great day.
And if you didn't get to ask us any questions here, feel free to email Dave or I, and we'll be happy to get you guys the answers that you need.
Okay, somebody's rooting for a Subway Series. We've already had one of those. It went the way of the Yankees. We'll leave it at that. Let's hope it just goes that way. Okay. Thank you, everybody. Have a good one.
Bye now.